Good afternoon, everyone, and welcome to our special FinTech at CSAIL lecture series. And I'm very pleased to introduce today's speaker to you all, Haoxiang Zhu. And Haoxiang Zhu is the Gordon White Billard Professor of Management and Finance and Associate Professor of Finance at MIT, Sloan School. And he currently serves as Finance Department Editor of Management Science and Associate Editor of Journal of Finance. He has previously served as the academic expert for the U.S. Commodity Future Trading Commission and the Bank of International Settlements. And he's currently a member of the Federal Reserve Bank of Chicago Working Group on Financial Markets. The FinTech CSAIL lecture series more broadly focuses on current trends and the latest research impacting financial technology, and is brought to you by FinTech at CSAIL, a research initiative at CSAIL supported by 8 board member companies: Bank for International Settlements, Bank Negara Malaysia, Bank of New York Mellon, Canadian Imperial Bank of Commerce, Fidelity Investment, Itaú Unibanco, NASDAQ, and Ryan LCC. Thank you all. And the FinTech CSAIL initiative is part of the CSAIL Alliance program. And we've been active for 3 years, and we are currently funding 15 projects at CSAIL this year, representing a truly diverse range of research group in the lab, covering cybersecurity, AI and machine learning, policy, natural language processing, big data, and blockchain projects. And if members in the audience are interested in staying connected with CSAIL Alliance, please consider joining our mailing list, and we'll link you directly to the chat. And with that, I'm going to hand things over to Professor Zhu to begin. Thank you, Professor Zhu.
Right, Shafi, thank you so much for the kind introduction, and I want to thank MIT CSAIL for the invitation. It's my great pleasure to be here. I currently work at MIT Sloan, and many years ago, I was a computer science major for my undergrad. So there's a second connection here, I guess. But today I will talk mostly as an economist, financial economist, think about what are the central bank digital currency designs and what features we could introduce or add or adjust, right, to make it desirable for households and for society. And this is based on the joint work with Rod Garrett of UCSB and Jiaheng Yu, who is a student at MIT. Just to motivate, what is a central bank digital currency? According to the definition from the Bank for International Settlement, I guess we don't have to go with their definition, but one definition is that it is a digital payment instrument that is that direct liability of the central bank. And there are retail CBDCs and there are wholesale CBDCs. Today's talk, I will focus on the retail CBDC. As you can see from this chart, I'm taking from the BIS report, the interest among the central banks in studying or experimenting or research into CBDC has been increasing steadily over time, even though only very few have actually started piloting. This is a slightly different chart using their data and others, showing that a wide variety of countries have already ventured into this space. And clearly, you see the 5 that are said to be launched. Those are relatively small island economies. The biggest one of the 5 is the Bahamas, the sand dollar, whereas the United States, for example, currently is in the research stage. Now, why do we care about the CBDC all of a sudden? I think there are catalysts. Clearly, Facebook's Libra back then was a big catalyst, but among many other things, there are legitimate and fundamental reasons that CBDC could be useful in the economy. And again, in this chart, I'm taking from the BIS report, you can see from the bottom left, there are broadly 2 kinds of objectives among the central banks. The first one is broadly about improving the payment system. You can see that it's about robustness, about the safety and efficiency. We can kind of extend that into financial inclusion, meaning the lowest income or the kind of poorest households in the economy are still able to make payments and therefore embedded into the financial system, and also financial stability. The second side of objective is about monetary policy transmission or monetary policy implementation. Namely, as the central bank moves interest rate or conduct other asset purchases, it's going to, the implication on the interest rate going to pass into, say, deposit interest rate very fast. Now, how do we implement these objectives? One of the quotes, which I like a lot, is from Ben Broadbent, the deputy governor of Bank of England. He said that, as early, I guess in this space, as early as 2016, if all the CBDC did was to substitute for cash, meaning it has no interest, bears no interest, and doesn't really provide any services, then people will just hold the commercial bank deposit. And I think that makes a lot of sense. And in a way, this is how we approach this problem, to consider the fundamental properties of a currency. Now, what is a currency? A currency is a store of value, and that is related to the interest-bearing property of the CBDC. Imagine you have inflation, which we see a bit right now. By paying some interest on the CBDC, is going to kind of keep the value of the savings of the households. Now, the medium of exchange property is related to the payment services. That's kind of obvious. And the final property of a currency, usually we say that's unit of account. That is automatically satisfied if the currency is issued by the central bank, such as the Fed. So by looking at these properties, we try to get a sort of a comprehensive view about how the central bank digital currency might fit into the whole scheme of money and currency. Let me give you 3 stylized examples, real examples of how different central banks are kind of taking this direction. The first one is the Swedish e-krona pilot. For a very long time, people actually watched the Swedish central bank very closely because they were widely believed back then that they're going to be the first central bank pushing out the CBDC. The cash usage in Nordic countries has been very low, and indeed in Sweden too. So the Swedish central bank recently completed phase 1 of e-krona pilot. It is a blockchain. It's a private blockchain owned by the central bank, and the digital currency is distributed from the central bank to the participants, such as banks, and then to the households. In the pilot, it didn't really kind of test the interest bearing capacity, but it discussed, there's some interesting discussion of whether one could impose a negative interest rate if you have a token-based currency. As this e-krona is. Now, the second example is the Chinese CBDC pilot. It is called the DCEP there, Digital Currency Electronic Payments. Just like the Swedish design, it is layered. The central bank distribute the digital currency to the middle layer, commercial banks and large telecommunication networks. And then this middle layer would distribute to the households. It doesn't really pay any interest. It is mainly used as a substitute for physical cash. The final example, which I thought is the most interesting of all, is actually one of the proposals put up in the US Congress. As far as I know, it's not passed. But look at this specific text. It's about digital dollar, right? Number 1, it says there's no fee. You shouldn't impose any fee on people. And the currency, the digital wallet should pay interest. That is no lower than how much the Federal Reserve is paying the banks. Now that's already very high interest. Point 2 and 3 says you probably want a lot of services, provide a lot of services. And by the way, if you happen to live in an area that is not easy to get access to a bank, you can get a digital currency from your post office. So the US proposal is interesting in the sense that it tries to really achieve the maximum on both the current the interest rate dimension as well as the convenience dimension. Now, with that motivation, what do I do? What do we do in this research? We are studying the design of a CBDC in 2 dimensions, interest-bearing and convenience. I should mention that in our model, and it is also my view, that the CBDC is likely to be offered through commercial banks or other third-party providers because it is difficult for the central bank to do all the KYC, AML, right, know your customer, anti-money laundering, kind of work, so it's sort of efficient to rely on the existing infrastructure. Therefore, the CBDC by itself is not anonymous. There is really no dimension of anonymity that differs the CBDC in our model from a commercial bank deposit. But it will be different in the interest-bearing and the convenience direction. We're going to embed this design into a model with large and small banks. These 2 banks would compete on deposit market and lending market. The interest-bearing CBDC would have a nice property that it controls indirectly the interest rate that banks pay us, the households. It's going to be a lower bound. If you increase the CBDC's interest rate, it's going to speed up monetary policy transmission, meaning whatever the central bank says on the interest rate, depositors will feel it. As opposed right now that I'm sure the large banks really do not pay much on the deposit, our deposit accounts. Now, the convenient CBDC does the opposite. But I forgot to mention that interest-bearing CBDC increase monetary policy transmission, but the downside is that it's going to reduce the market share of the small banks. in that sense, it's not really kind of leveling playing field, making the playing field even more uneven. The convenient CBDC does the opposite. It's going to level the playing field by, in a sense, providing some additional, I would say, service or give the small bank a leg up. The small bank will benefit from a convenient CBDC. And in addition, if the CBDC convenience value is actually high enough, it's going to also increase the monetary policy transmission. So in that regard, the convenient CBDC seems to be quite desirable. In addition, we have asked the question, if the central bank were to introduce such a CBDC, who wins and who loses? If we want to sort of take this as an actionable idea, we need to make sure that the stakeholders are at least on board. Turns out that the banks and households strongly disagree on the interest-bearing capacity, on the interest-bearing property, because any increase in the interest rate of the CBDC is going to lead to a lower profit on the banks, and the banks dislike that, even though the households like it. On the other dimension, which is convenience, it happens that the two stakeholders actually agree on to a certain point. And this is the interesting result in our view, because it gives us the common ground to work with so that we could derive what we call the CBDC frontier. It is a frontier, it's a combination of interest rates and the convenience value in the CBDC design that is, in a sense, as good as possible. Meaning, if you move away from that, then either both parties would want to kind of move it back to the frontier, or at least one party would disagree. So in that sense, it's a frontier. That's sort of the common denominator that everybody agrees on. And along the frontier, exactly which point you pick really depends on the specific objectives of the central bank. Let me just give you a view of the preview of this frontier. That's the end result, right? Here on the x-axis, we have the interest-bearing capacity or the interest rate on the CBDC, whereas on y-axis, we have the convenience value of the CBDC. The frontier is this orange line. It simply says, for every possible value of interest rate, what is the maximum convenience value that the central bank could provide so that both parties, households and banks are happy? And also, if you sort of move down to here, this cross basically dominates this triangle. So there's no reason to move away from the frontier. Now, if you move it up, then some people might be really unhappy. So that's what we mean by kind of common denominator. And for the most of the talk, I will kind of develop into the theory and try to, in the end, will derive this endogenous frontier, okay? Let me skip the literature in the interest of the time. It will be an economic model, and I will talk about the model, talk about the separate properties of interest-bearing and convenience. And finally, we kind of arrive at this CBDC frontier very naturally rising from these properties of the market. Very quick word, why do we care about the economic model? It's true that I think in the practical discussions, there are many interesting discussions about the technology capacity, right? Exactly how to implement it. Do we want it to be token-based? Do we want it to be account-based? What kind of technology should we use? Centralized, decentralized, etc. That's certainly very useful. On the other hand, it's also very useful to think about economic incentives, because whatever design the central bank puts in is going to alter the incentives of households and banks, and that will lead to different outcomes. So the role of economic model is to make predictions on what happens in the economy when something new is added, right? Before seeing this then actually implemented. Equally importantly, the model will tell us who wins and who loses, and that allows us to derive a common ground of agreement among the stakeholders. And the frontier, in the sense, is the set of common grounds. For the next 20 minutes or so, I'm going to talk about the model. There are specific features of the model that are not too critical for the eventual CBDC frontier, but I do want to highlight a few things throughout. So here we have a big bank and a small bank. When you're considering heterogeneous banks, think about the economy like the US, where you have a few very large banks and you have a bunch of very small ones. And the large banks are much larger than the small ones, of course. And the banks in our model hold reserves, and these reserves, we denote them as X. They are the asset of the bank, whereas the liability of the bank are the deposits that you and I hold, right? Household would hold deposits, whereas the bank holds the deposit at the central bank. The central bank, the Fed, pays interest on reserve F to banks. We call that interest on reserve. Currently, it's between 0 and 25 basis points. And the bank would set the deposit interest rate to the households, RL and RS. Currently, on most of the large banks, is pretty close to 0. We are going to model the difference between large and small banks along this single dimension, which is the convenience of payments. We are going to model in a somewhat abstract way. If you take a depositor randomly in the population, the depositor might have a preference for the large bank, and we call that preference, we call that delta. Delta has a distribution, we call that G. I'm just taking this concrete example of a super app, right? This is actually one of the third-party providers in China, Alibaba. If you look at this, certainly there are so many different services one could connect using the single app, right? And one could think about the convenience value of a large bank coming from a better app, or maybe from extensive bank branches or other services. And some people, of course, do not care about all of this. And in that case, that person's delta would be 0. A CBDC is the central bank's liability, but is going to be offered through the commercial banks, just like the current design in Sweden, in China, in many other countries, at least in the conceptual stage. The CBDC has its own convenience value. We call that V. Here, I'm showing a very simple schematic on how to think about this convenience value in this very concrete setting. We have the large bank application app. You get a payment functionality, that's usual thing. But then you get a bunch of other things such as ride, Uber, Lyft, right? Take the car loan, go to dining and travel, you get discount on those. So that's auxiliary services that the app could potentially provide that people have different values on. The small bank doesn't have any of these, right? Now the CBDC account is kind of between, it doesn't have all these, connection to the private services, but they might have some other properties such as if you touch the phone of your friend, yeah, you can make payments. So in that regard, the CBDC account provides some convenience, but not exactly the same as a large bank's account. Because the CBDC account is offered through commercial banks, one could, put money between the CBDC account and the bank account seamlessly. Therefore, the depositor's convenience value for going to the large bank is essentially the maximum of the two. Its own convenience value of the large bank delta and the CBDC convenience value V. Whereas for the small bank, it is simply V because the small bank's own convenience value is normalized to be 0. In that sense, within each bank account, large or small, the CBDC account and the commercial bank deposit account serve as almost a perfect substitute in terms of convenience. What it means is that whatever interest rate the CBDC pays will be a lower bound on the bank's deposit interest rate. If the Fed pays me 50 basis points, Bank of America would have to match, because otherwise I would move all my money to the Fed balance sheet. That means the interest rate lower bound is the central bank interest rate. Just to be sure that the CBDC does not have to be convenient. On the right-hand side, I'm showing a quite inconvenient CBDC that with a value of 0, V of 0, because it doesn't have any payment functionality. All it does potentially is a short-term investment vehicle that pays interest rate of S. And if you want to pay, hey, move the money away from the central bank and put into the large or small banks app, and then you can pay from there. So the timeline of model is organized as follows. I'm going to construct this very simple, a mini version of the economy. There will be, people who require financing. We call them entrepreneurs, like the, say MIT graduate student after graduation. They have a great idea, and this great idea needs financing to implement. And the entrepreneurs, they could hire people as workers, and eventually the workers become depositors. So in the very beginning, the banks would set the deposit interest rate. We call that RL and RS. The central bank set the interest rate paid to the banks. We call that interest on reserve, F. There is a central bank interest rate. We call that S, and the convenience value, V. Every agent, meaning every person, already has an account with either one of the big, either one of the commercial banks. Every agent is endowed with a project. That's the MIT graduate who is going to borrow $1 from the bank to finance the projects. The projects, different in terms of the quality. and the bank is going to price it as a monopolist because this person, right, this graduate student only has account presumably with one bank, we're assuming. And if the loan is granted, then the funded entrepreneur will pay a worker to work on this. Now, the role of the worker is essentially to lead to some flow of funds in the economy. Okay, once the worker receives the wage, he or she is going to deposit depending on the interest rates of the two banks and the community's value that that person derives. And finally, all the payoff are realized and the interests are paid. That's basically the model. So we're going to think about the CBDC's role in this model, how it changes deposit market, how it changes the lending market, how it changes the profit of banks, as well as the surplus of the agents. Before going to the solution of the equilibrium, which actually I'll be real quick, I want to emphasize a few things on this slide. In the discussion of a CBDC, you do hear a lot of comments from the banks, in particular the large banks, that a CBDC is going to reduce lending, a CBDC might be disruptive. And to sort of understand that argument, I think it's useful to kind of have a slightly deeper look into exactly what way the CBDC might be disruptive. And this slide is supposed to do that. We are going to start from the beginning balance sheet on the top. In the middle, it says, if the bank makes a loan, then what happens to the balance sheet? Sometimes it is perceived, or at least portrayed in the popular press, that if you lend money, then the money flows out of the bank, right? It's almost like you lose deposit, whereas as you lend out money. It's not actually how it works. How it works is that when the bank creates makes a loan, it's going to create a new deposit, which adds up onto the existing deposit. At the same time, the bank is going to create a loan on the other side, on the asset side of the balance sheet. So imagine if I borrow money to buy a car, my bank would create a loan in my name and also a deposit in my name. Now, once I have the money, I'm going to pay the dealer, right? When I pay the dealer, the money will flow out of the bank. However, there's a high chance, non-trivial chance, that the dealership had the same bank account with the same bank, say Bank of America. So in that sense, the money may not flow out of the bank at all. In this economy, we got a large bank and a small bank. With the probability alpha S, the worker deposits the money with the small bank, so the money leaves the large bank. But with probability alpha L, the money actually stays. So probabilistically, or if you think about aggregating many depositors across the economy, the depositors actually leave some money out, but the new deposit would be alpha L. So the bank still keeps the deposit, part of it. Then what happens with the bank profit in terms of making the loan is that the bank makes two profits every dollar it lends out. Number one, look at the bottom equation. The bank's going to make a profit on the loan itself. So that's the quality of the loan times the 1 plus interest rate minus the 1 plus the opportunity cost of money, if you like. And the second term, which is very important, is the probability alpha, the money stays with the bank, and the interest rate spread that the bank could earn between the central bank and the depositors. Right, the central bank pays F, whereas the depositors need to be paid RL. So the second term is actually going to be different between large and small banks. That's going to lead to a lot of reallocation of activities between the large and small banks when the central bank digital currency is introduced. For now, you can kind of keep in mind that the second term is quite important. Just to motivate the idea that, hey, is that true that a dollar lent out may come back? This chart shows the deposit market share of the top 4 banks in the United States. You see that Bank of America, Chase, Wells Fargo have a deposit share of roughly 10% each. Bank of America at some point had the deposit market share above 12%. So yes, if you borrow from a Chase and pay somebody else, then there's a high chance that the newly created deposit would stay with Chase. Now the equilibrium will be derived in a fairly straightforward fashion. I'm going to just talk a bit right here because it's important about the convenience value. This table shows what the convenience value at the interest rate the household or the depositor could derive by going to the large bank versus the small one. The central bank digital currency offers a convenience value V. So for the large bank, the household basically derives the maximum of the two, Whereas for the small bank, it is simply CBDC's convenience value that the depositor is receiving. So we are going to restrict attention to equilibrium where the large bank pays the lower interest rate, which seems to be quite intuitive. So in that case, we could show that only if you prefer the large bank's deposit or deposit account or services sufficiently larger than the threshold, you are going to use the large bank account. So that's going to give us the small bank and the large banks, so large and small deposit market share, 1 minus G and G. And we could also derive the lending threshold, lending standards, just because of this term. One could show that the large bank actually uses a lower lending standards than the small bank. And then one would maximize the profits and all that. I'm going to skip these equations. Basically, it says that the bank is going to optimize the profit by setting on the deposit interest rate, and the central bank kind of set F and S exogenously. There are two possible cases of equilibrium. In one case, I'm just draw this right here illustratively. Suppose this is the bank's profit, and here is the large bank's deposit interest rate. The large bank's profit is going to look like this. There will be an interior solution. However, if the central bank digital currency's interest rate is S, then you basically force large bank to be in the corner, because RL in this case got to be at least as high as the CBDC's interest rate. So depending on whether the large bank is constrained by the lower bound, we're going to have a constrained versus unconstrained equilibrium. But in both cases, we can show that the large bank offers lower deposit interest rate, has a larger market share, and a looser lending standards. Okay. Now with this, we can now talk about the impact of the design features of interest rate and the convenience value. Now, broadly speaking, right here, I just show pretty much the charts to convey the intuition. Now, what's the impact of increasing CBDC interest rate? Well, that's going to enhance monetary policy, because once the deposit market share, the deposit interest rate have a lower bound, by increasing the lower bounds, one could actually increase the deposit interest rate in the economy. So whatever the Fed does is going to pass on into deposit market faster. And that, in terms of monetary policy pass-through, it is desirable. But what is less desirable is that the interest rate spread between F, which is the central bank interest rate to pay to the banks, and the CBDC interest rate, which is paid to the households, start to shrink. When they start to shrink, it's going to reduce the scope of competition by the small bank. The small bank can no longer compete with the price effectively. Therefore, it's going to lose market share. This is exactly what happens in this illustration. I'm just showing using a simple example of uniform distribution with the large bank's preference. We can see that as interest rate of a CBDC goes up, the weighted average deposit interest rate, the black line, goes up. But activity actually shifts right from the small bank to the large bank. So in that sense, a very high CBDC interest rate is not as favorable for leveling playing field or for financial inclusion, and many other features that is, if we think about them as associated with small firms, small communities, small banks, right? This is about lending, as usual, just like the deposit market share, the small banks lending share in the economy also declines because it now has a lower market share on the deposits. So that's, in a sense, is not as desirable, even though there is a high monetary policy pass-through. Here's the formal results. Basically, the tension we are looking at is that the weighted average deposit rate goes up, but the small bank's market share, you can see that it goes down. Now, the convenience value is different. If you think about convenience value, it's more like a technology solution. You want the CBDC to be easy to use and potentially cheaper to use. In this economy, the large bank's advantage is primarily in its convenience value. It's a super app. It's a lot of branches, etc. Once the CBDC introduces a very good payment service features, then it's going to chip away the large bank's profit, large bank's benefit in that regard. So the gap between large and small banks would start to shrink. Mathematically, if we take that difference, right, the max of delta V minus V, by definition is going to be less than delta. The delta is the starting difference, and the left-hand side is the difference after the CBDC is introduced. So in that regard, it's going to level the playing field. Small banks benefit for sure. And the path through monetary policy could be positive or negative, depending on V. I think this last part is quite interesting because it doesn't go necessarily one way. Again, to illustrate this idea using this uniform distribution, on the x-axis, I'm showing the CBDC convenience value as this number goes up. In the constrained equilibrium, again, in constrained equilibrium, that means the large banks interest rate, RL, in this case is equal to central bank digital currency rate, which is assumed to be 0, it's going to be stuck at 0. Now, in this case, by increasing the CBDC convenience value, it actually reduces the small banks' interest rate. Now, the intuition is that once the small bank's app becomes easier to use by connecting to the CBDC app, then the small bank does not have to provide as high interest to attract households. I'll be happy to use the small bank's app if it makes the payment easy and cheap, rather than asking for more deposit interest rate. Then what this means is that the weighted average deposit interest rate in the economy actually goes down. That is going to translate into a higher bank's profit overall, as you can imagine. Now, once the CBDC convenience value goes high enough, we see the opposite happens. That's because while the convenience value still kind of keep reducing the small bank's interest rate, but it's going to increase large banks' interest rate. Now, Bank of America and Chase and Wells Fargo feel compelled to compete. And in that case, the deposit interest rates start to rise and the total bank deposit tends to go down, right? So that's quite interesting given this non-monotonicity. On the right-hand side, we do see that the small bank's market share does go up monotonically as the convenience value of the CBDC goes up. So here is the sort of formal results. Let me just highlight that you see these 4 entries, that the loan volume of the deposit market share for the small bank activity would actually go up. Now we are ready to talk about the frontier, which is sort of, as I said, once we get all the features together, we can derive this frontier. When we think about the frontier, we ask the stakeholders, which design do you like? In this economy, very simple one, there are 2 major stakeholders. Number 1 is depositors, number 2 is banks. So we talk about each of them in turn. Depositors, we call them welfare. Let's think about this economic surplus, come from 2 sources. The first is the weighted average interest rate you could get from your bank account. The second is the payment convenience, right? How easy it is to use to make payments, make debits, direct deposit, etc. One could show that under fairly general conditions, that a higher CBDC interest rate or higher CBDC convenience value increases household welfare. They like it. Basically, we all like higher interest rate. We like better apps. That seems to be quite intuitive. If we draw this on the chart, it looks like this. These are in difference curves. On the x-axis, we have CBDC interest rate. On the y-axis, we have CBDC convenience value. Every curve, you see the red curves, represent combinations of S and V, so that depositors altogether are equally well off, right? So as a depositor, I'm happy to take this point as I am to take this point. There are different combinations, but overall, I'm equally happy under this, this particular preference. And obviously, if we look at where the numbers increase, they want to go northwest, right? Higher S and higher V. Now, what are the boundaries? So these boundaries says the interest rate between large and small banks are equal, so that we could in principle kind of move it up even a little more, but it's kind of tricky to think about the CBDC going to change the market so much. So we're going to stop right here. And the blue dots are constrained equilibrium, whereas the green ones are unconstrained. So in this equilibrium, RL is equal to the central bank digital currency deposit interest rate. In the foreseeable future, I do believe that constrained equilibrium will be more relevant because the interest rate has been low and likely remain low for a bit, right? So here I'm assuming 2%. Now, for now, remember that depositors want to go northeast. What about banks? One could solve the same thing for banks. Turns out the total profit of banks increase in V in the constrained equilibrium. Let me just emphasize this point. In other words, when the large banks interest rate is stuck at the CBDC interest rate, kind of lower bound, collectively, the banks want a higher convenience value offered by the central bank. This is because a higher convenience value of the CBDC reduces the average deposit interest rate in the economy. So that's why banking sector kind of likes it in this sense. And obviously, once V start to go even higher, you see that's decrease in V and total bank profit decrease in V. And not surprisingly, that the total bank profit will decrease in the interest rate. However, a higher V increases the minimum of the two. I'll talk about this a bit later. Has to do with the financial stability. So now if we look at this indifference curves of banks, they look slightly different, right? In the blue region, if we ask the question, in which direction do banks' preference go up or profits go up? You see that it's actually not in the south direction, but rather northwest, right? They want to go this way. Because in the constrained equilibrium, they would prefer very clearly a lower interest rate, but they would actually prefer a higher convenience value of the CBDC. Again, because the CBDC convenience value reduces the average deposit interest rate that benefits the banks. If we combine them together, you see there's an agreement between households and banks. They all want the CBDC to have a good payment properties, but they disagree very strongly about the interest rate. Now that's going to give us this frontier plotted in orange. So the way to read it is the following. The red curves are the indifference curves of households. So for any 2 points on a given curve, the households are equally well off, right? So as a depositor, I'm equally happy between these 2 points on this red curve. Now, if we fix this curve from the red, and we ask the question, how do we move the bank's preference? How can we make the banks as happy as possible? And clearly you want to go northwest, right? So in the end, you move the blue curve to the left, and we can arrive at this point, right? Now, conversely, for the bank, they are equally happy between these 2 points. And what we do is to move the red curve to northeast. And in the end, we're going to reach this point. So after doing this kind of exercise, we see that, yeah, the orange line is the frontier. In other words, if you pick a point here and you pick a point right below it, the point on the frontier will dominate all the points below it. Now, what about here? Can we reach this area? The answer is, in this area, in the unconstrained equilibrium, the bank's profit decreases in the convenience value of the CBDC, whereas the depositor's welfare or consumer welfare increases in the convenience value of the CBDC. So they disagree. So there's no way to move above the frontier without a fight, right? So think about the frontier at the set of common grounds. That's as good a common ground as we could get in this very simple economy. So this is what I said, that for any interest rate S, the CBDC frontier gives the what economists like to call a Pareto optimal, meaning it's difficult to make everybody better off, right? If you make one better off, depositors or banks, you're going to make the other one worse off. So the saddle point at which we cannot further Pareto improve would be thought of as a frontier. So we're going to focus on the constrained equilibrium because it's likely to be relevant for the near future. But exactly which point should we pick along that frontier, that depends on the objectives of the central bank. So here are some examples. Imagine the central bank wants to maximize monetary policy pass-through or maximize the depositor's welfare. Then they're going to pick the highest interest rate right here. You can see that the depositor welfare is highest on the orange line. So I guess on the yellow line, whereas on the right line, where the yellow line is the weighted average interest rate. So this is the monetary policy, and this one is the deposit market share. But the banks dislike it. If the central bank wants to make the banks profitable and therefore stable, they might pick this point. Now, the more interesting case, perhaps, are these interior points right here. If we want to level the playing field, thinking about increasing the market share of the weakest player in this economy would be the small bank. And that's going to correspond to the interior point right here. You can see that the market share of the small bank. And also, the minimum profit between the large and small bank can be thought of as a measure of financial stability, because the less profitable one is more likely to default. So if any bank were to default, the smallest one tends to default first. by raising the minimum of the two, it enhances stability. So that's quite interesting as it picks this interior solution. In this case, has a very modest interest rate, but has a pretty high convenience value, right? So that's kind of the takeaway in the sense of this research. It's a pretty fairly stylized economic model, but we try to present this trade-off between convenience value and interest rate. So what are the takeaways? A few model highlights just to mention, in the context of this discussion. We model the deposit market and the lending market with the different banks. We pay close attention to the composition and competition of the market, because in a way, small banks, again, are connected to small firms and small communities. There's a reason to care about the composition effect the central bank has on the economy. In this model, large banks' advantages mostly come from the convenience value of the deposits, this account, better app, a lot of branches, etc., more services. And the banks have a lot of reserves, so that they also earn interest from the central bank, which is a very important property. And finally, money lent out by the large bank or the small bank could come back to the bank. Actually, they may not leave the bank at all if whoever received the money in the normal function of the economy has the same bank and put the money there. So in that sense, the large bank has a very natural advantage in lending as well. So that means the lower opportunity cost of lending and the lower lending standards. CBDC design comes in changing two things, right? I guess the first thing is on the interest rate of the economy is going to put a lower bound on the interest rate, and particularly binding for large bank. And that means a higher CBDC interest rate enhances monetary policy pass-through, but it has a downside of decreasing small banks' market share. So leveling playing field seems to be harmed in that way. A higher CBDC convenience value does the opposite. It levels the playing field by giving the small banks some help. And the monetary policy transmission is more nuanced, and some conditions might even go up. One property of this particular model is that the CBDC does not have to disintermediate any bank. The depositors do not have to move money into the CBDC because the commercial banks are competing with the CBDC by raising interest rate. And likewise, nobody borrows from the Fed, rather they borrow from commercial banks. So even without being used, I think the CBDC serving as an outside option is extremely helpful. Let me just end on this slide. That's the CBDC Frontier. Again, for every interest rate S, the CBDC Frontier gives the highest convenience value. That is, we call Pareto optimal, meaning you cannot improve it without any objection. And the way I think about it is that instead of searching this two-dimensional space, S and V, or all the combinations, we only need to search along this orange curve and ask the question, okay, where on the orange curve does the central bank want to land on? And that is likely to be quite different across different countries and across different bank objectives. Let me stop here and happy to answer questions or discuss.
Yeah, absolutely. Thank you so much, Professor Zhu. I do have a few questions for you. First, how does a centrally issued and managed central bank digital currency mesh with the decentralized nature of blockchain technology? And what are the financial privacy implications for citizens and end users?
That's a great question. In this particular research, I'm not, we're really not investigating sort of blockchain. The CBDC is offered through banks, but I can tell you my view. So currently, I guess in the decentralized system of, say, blockchain or other digital currency or cryptocurrencies, there's very little KYC and AML, anti-money laundering, and know your customer. So that means there is a lot of anonymity, but whether that's going to kind of continue indefinitely is not clear. As more economic activity move into that decentralized system, there will be pressure, right, from the official sector to think about, hey, we don't want to move, illicit or even illegal activities onto the chain. So there will probably be more control. In the Swedish experiment, the chain is actually private, meaning the central bank sees everything because it owns the chain. So my personal view is that going forward, the actual implementation of CBDC is likely to start from what the Swedish or other countries are doing, namely this layered system offered through commercial banks. So there's not a lot of privacy to speak with in the beginning, where the official sector might kind of watch very closely to say, Bitcoin or DeFi or Ethereum or the other platforms with more anonymity. I guess the implications is still kind of, the jury is still out on this one. And I personally, I certainly feel excited and curious on what will eventually happen.
Awesome. Thank you so much. Another question that came in, what countries are leading the race for developing, experimenting, and leading the implementation for CBDCs?
So the country that has already implemented, Bahamas has already implemented the standard dollar. Among the much larger countries, I guess the Chinese experiment seems to be the most further along. In the Chinese implementation, it is pretty much an app, right? In China, the third-party payment providers have been quite developed already, Alipay and WeChat Pay. So the central bank digital currency there tries to compete with those solutions in a certain sense. It's basically based on the phone. You can scan on the supermarket and spend the money. I think the US has been conservative, and rightfully so, right? If you want any central bank to be very conservative and not to mess up, probably you don't want the Fed to mess up this one. The ECB is also very conservative. The ECB did a study. I think one of the paramount concerns of the European citizens is about privacy. And clearly, once you have a CBDC, everything is potentially discoverable. So I would say that in developing countries, it's probably faster. Another example is this so-called M-Pesa mobile money in Kenya, in Africa, because in developing countries in general, a large fraction of the population are not banked. They don't have a bank account. So there's not much to disrupt. And there's less resistance from large banks as well. There, I think technology plays a very important role in enhancing payment services, especially for these unbanked customers. Whereas for developed countries like the US and Europe, the existing infrastructure seems to be working fine, and the incentives to kind of further innovate or disrupt, if you like, the existing system seems to be a little weaker. Yeah, that's my take. Developing market is leading the pack for sure.
Awesome. Thank you so much, Professor Zhu. I know Phil has a note.
Yes, thank you so much, Professor Zhu. Those were the only questions you received, and I want to thank you for sharing your time and expertise with us today. And sort of closing this event, I'd also like to thank all of our CSAIL Alliance member companies who joined us today and the rest of the MIT community. And in particular, I'd like to especially thank our FinTech at CSAIL board member companies who have made this FinTech at CSAIL research initiative possible over the last 3 years. That being the Bank Negara Malaysia, Bank of New York Mellon, Canadian Imperial Bank of Commerce, Bank for International Settlements, Itaú Unibanco, Fidelity Investments, NASDAQ, and Ryan. If you would like to stay in touch with CSAIL Alliances and join our mailing list, you can find that information in the chat, and we look forward to staying connected with you. And thank you again, Professor Zhu, for your time today.
Well, thank you very much for having me.
And with that, we can conclude. Thank you all.